Hello, welcome back. One of the subscribers of our channel actually asked to take a look at Yalla Group Limited, a very small company for which we have limited information about. Yet, luckily, the data provider that I'm using, the third party, actually has quite a few information about the company, and so I can actually make a video about it. This, as you can see, is a very small company. 374 employees is the recorded number over here. It's an Arab Emirates company, as you'll see. And we even have some key executives' names here. Okay, so let's take a little bit of a closer look at what the company is doing in terms of their stock analysis chart and basically ratios here and metrics. Now, if we take a look at the max chart, you will see that the company has been trending down. And since this was an IPO back in 2020 here, you will see that its first day was at $7, and right now it's actually sitting much lower at 4.05 is where it is right now, down 85% from its highs. Now, of course, we need to be taking a look at the financials to see whether this is an opportunity or we should just reject this company and move on to something else. Because after falling for that much, for such a long period of time, maybe it's an interesting opportunity to buy over here. Who knows? We have to examine that. Let's take a closer look and see. Now, the P ratio of the company is sitting at 9.46. Again, we have limited data. It's like a couple of years here. It used to be 700. It used to be much higher. Now it's trending lower. Price to free cash flow ratio, though, it's actually higher than what it used to be. So we are having a price to earnings ratio that's going down, which is good, and price to free cash flow ratio, which is going up, and it's worse. Let's take a look later and see what kind of things are happening in the financial statements. The thing that I don't like for sure is the fact that the company's outstanding shares are overall increasing, starting from 91 billion. For some reason, this is zero, but currently sitting at 144 million, actually increasing from like a couple of years ago, right? 2020 to 144 million, almost 57% higher. So that's a lot of dilution going on for shareholders that actually bought the beginning of its course here. The free cash flow to total liabilities ratio is very low, meaning that the company probably doesn't have a lot of debt. Yet their revenue growth and net income growth, pretty much free cash flow growth, are looking good, pretty good again for a relatively small company. Looks like they are doing well, and not much debt again. We kind of saw that here, but you can validate it with a debt to equity ratio as well. Pretty nice returns as well. So things are looking quite nice. Good net income margin here, good gross profit margin and all that. Things looking nice for this company, not gonna lie. Looks like we may have something here. But let's take a little bit of a closer look at the financial statements and see what's going on. 42 million is what they did in 2018, 273 in 2021. And the net income out of this one was 20 in 2017 and 82 in 2021 here. Pretty legit, not bad at all. So they keep increasing it, and it's only 2020 when it actually went down a little bit. The balance sheet of the company, let's take a look. Now here we will notice that the total liabilities of the company are sitting at 45 million and the total assets are at 380. I believe our total liabilities ratio compared to the free cash flow was less than 1, meaning that our free cash flow ratio will be about that range, maybe a little bit more actually. And the total equity here is also getting increased, again, since this is calculated by deducting liabilities from assets here, the total numbers. Cash flow statement is the most important thing, of course, and you will see here the top line is the net income. And if we actually break it down, we're looking at a company that's generating more cash flow by operating activities actually as the years progress, which is nice to see. A little bit of depreciation added back, some stock-based compensation expected, and actually stock-based compensation is a big chunk, likely the biggest chunk pretty much. It gets deducted by the net income and added back to the free cash flow here. And you will see that we started at 23 million and right now we're sitting at 64 almost. So it is increasing their cash flow, the free cash flow of the company. But let's take a look at the stock evaluation tool because things are looking okay. Things are looking relatively nice for the company. It's doing pretty well. But what comes out of our analysis in terms of paying for the stock? Like how much should we be paying for this one? The revenue growth, of course, has been tremendous. This is a new IPO. You could expect it to increase its revenues vastly in the next few years. So I'm not gonna be too conservative. I'm gonna go relatively high because I'm seeing that the company is probably gonna be doing well in terms of growing the revenue. So I am gonna go relatively high. I'm gonna go 30, 35, and 40. Again, this is aggressive, very aggressive, but I wanna see what I'm getting out of this, and maybe then I can tone it down a little bit. Now the net income margin, as I'm seeing here, again we kind of have the handy 4-year average here. You see 5-year, but it's practically 4 because that's what we have data for. 31.91 is what I'm getting here. But last year they did 2, so there's a big discrepancy there. Now I don't know if this is going to be the odd one out, but I have to be a little bit more conservative here. So I'm still gonna go 10, 20, and 30. Yet they have been making 47 and 45 here, so at least that's worth noting. And for the free cash flow margin, I think it makes a ton of sense to use something near the 100 number. So I'm gonna go 100, 110, and 115. And the annual return that I typically want to make is 13% here, because I can get 10% out of an S&P 500 ETF, and I have more risk here. I need to be making more. So let's hit calculate and see how much we're getting for this small company. And you will see that with these estimates, with a rather aggressive though, remember that, we are getting that the stock price actually is fairly low right now, and it could be a potentially interesting buy right here, this company, Yalla. So it's definitely worth consideration, that's for sure. I want to try some numbers and be a little bit more conservative here, because the net income margin is conservative, that's true, and the free cash flow margin makes a ton of sense as well. The revenue margins, the revenue growths may be a little bit elevated here. So I'm gonna go more conservative. I'm gonna go 15, 17, and 20 here, which I think is very conservative based on what we're seeing from the company actually. But still, I just wanted for the exercise to look at that as well. And even with this kind of revenue growth for the 20 as our high here, which I think is very, very achievable for the company in the next 5 years, we're looking at a current price of $4 and a high estimate of 6.55. So based on what I'm seeing here, I kind of like what I'm seeing from this company. A small company, it may be actually worthwhile adding a little bit of money here and see how that turns out to be in the next few years, because there is a relatively limited risk based on what I'm seeing, and you can maybe put some money a little bit into work and let it grow and see how the company will be growing in the future, because it does look like their financials are not bad at all, and being a small company, they have tons of space to grow actually, tons of potential really, and they seem to be doing better and better every year, so that's good to see. And the most important thing is, of course, the fact that not that they lost the value in terms of their stock price, which of course it helps, but the fact that their stock price is not very elevated when you compare it to what they're doing financially. It seems like it's actually even undervalued. So that's great to see. And so yeah, I think that this is a pretty interesting opportunity right now. The only thing that I really dislike about this company is the outstanding shares count, which keeps increasing here. That's practically the only thing. But I do like some other things, like I really like the return on capital employed or invested capital. These are similar but not exactly the same. Return on equity, pretty great. Net margins here, pretty good stuff for a little debt. So yeah, I like this company. I kind of like it. So I hope you enjoyed this video, you enjoyed this one. Please leave a like if you did, and thank you to the subscriber that suggested this company. Interesting little company. I hope this video kind of helped you a little bit, gave you some ideas. And thanks for the suggestion. And to the rest of you guys, please remember to leave a like if you enjoy this kind of small companies analysis. I think they are interesting to take a look at every now and then. Very interesting companies, some of these. And please remember to subscribe as well. Monday, actually, I'm opening up this tool to everybody, so I will let you know how to get it. You may want to be subscribed for when that happens. You can get a notification very quickly, and so you can actually get access to our tool. Thank you for watching the video, and I'll see you in the very next one very soon. Bye-bye.